Hello everyone, I want you to consider this. What do your eyes truly focus on when analyzing a price chart? Many traders primarily observe candles moving up and down, identifying patterns or drawing lines. However, they're often missing the single most crucial data point available: volume. Think of price as merely the market's advertisement, a mere signal. Volume, on the other hand, represents the genuine activity and actual transactions taking place. It's akin to evaluating a restaurant solely by its attractive exterior sign, completely ignoring whether any patrons are actually dining inside. In this video, my aim is to demonstrate the correct way to interpret trading volume, going beyond just understanding what it is. I'll explain its true significance, why it holds such importance, and how you can utilize it to discern the real forces behind every market movement. After watching this, every candle on your chart will begin to narrate a compelling story, with volume providing the undeniable evidence. This is purely for educational purposes and should not be considered financial advice. Let's delve into the fundamentals. Essentially, every chart communicates using two distinct languages simultaneously, offering a comprehensive view. The first language is price. This tells you precisely what occurred. Did the market ascend, descend, or move sideways? Price serves as the headline, the main news title of the market's daily events, giving you the immediate outcome. The second language is volume. This reveals the degree of conviction that propelled a specific move, indicating participation. It highlights how many traders were involved and the actual amount of capital that changed hands, providing depth to the action. Volume acts as the concrete evidence, the verifiable proof behind the price action. Consider it like an election process. Price represents the election result, showing who emerged victorious. But volume signifies the total number of voters who cast their ballots. If only a handful of people cast their votes, the election outcome holds little significance. However, millions of ballots represent a definitive statement. The same principle applies to market movements. Therefore, a substantial upward price movement occurring with minimal trading volume should immediately raise questions. Conversely, a significant price surge accompanied by high volume indicates strong market conviction and a genuine shift. Moving forward, when you analyze any chart, don't just inquire about price direction, but also about the financial weight supporting that change. Now, let me introduce what I believe is the most critical concept you'll encounter throughout this entire presentation. To accurately interpret volume, you only need to grasp one fundamental mental framework. This singular framework is known as effort versus result. Within the market context, effort directly corresponds to trading volume, reflecting the energy and capital deployed. The result is then visually represented by the candle, showing precisely how much the price has shifted. To better understand this, imagine the scenario of attempting to move a car uphill. In this analogy, the pressure you apply to the gas pedal symbolizes the effort being exerted. The distance your vehicle travels up the incline represents the direct outcome or result. Consider the first case. You engage the accelerator, and the car moves forward smoothly, demonstrating a clear correlation between significant effort and a substantial result. On a trading chart, this translates to a large price candle underpinned by robust volume, indicating strong buying conviction and a legitimate market move. It's akin to an entire stadium rising to its feet in a unified cheer, signifying authentic enthusiasm and widespread support. Now, consider a second scenario. You press the accelerator down hard, the engine screams, and fuel is consumed rapidly. Yet, despite this immense effort, the vehicle barely budges, as if an unseen obstruction is impeding its progress. In trading terms, this translates to a very small price candle accompanied by an exceptionally high volume. a phenomenon known as absorption. What's truly occurring here is that buyers are exerting significant pressure, but they are met with an invisible barrier. A substantial seller, often referred to as smart money, is strategically positioned, silently taking on every incoming buy order. Picture a dam. Water continuously flows into it, but the structure successfully contains and holds it all back. Eventually, when the water, or the buyer's momentum, is depleted, there's no remaining force to propel the price higher. Consequently, it's very common for the price to experience a swift and significant decline. Moving to a third situation. You apply minimal pressure to the gas, yet the car continues to ascend the hill effortlessly, encountering no resistance on an open road. On a chart, this scenario manifests as price increasing with very low trading volume, a condition termed no supply. This doesn't necessarily indicate overwhelming buyer strength. Rather, it signifies a complete absence of sellers in the market. With no sellers present, the market requires very little effort or buying pressure to continue its upward movement. It's comparable to walking down an unpopulated road where there's absolutely no one to obstruct your path. To summarize, here's your quick reference: the volume matrix. High volume with a large candle indicates a healthy market move, while high volume with a small candle signals absorption. Thirdly, low volume combined with price movement acts as a warning, indicating either no supply or no demand when one market side is absent. Commit these three distinct volume-price combinations to memory, as they form the fundamental basis for all subsequent analysis. Let's now apply the effort versus result principle to specific candlestick patterns, a method known as volume spread analysis, VSA. Every trader should learn to recognize three key patterns, beginning with the first one: stopping volume. Picture a market where prices are in free fall, marked by one red candle after another, as panic incites widespread selling. Then, observe a tall red candle emerge, with its corresponding volume bar beneath appearing enormous, the largest seen in weeks. This candle doesn't close at its absolute lowest point. Instead, it displays a long wick below with the closing price near the middle. A powerful, well-funded entity purchased every single asset that panicked sellers were offloading. This market decline wasn't halted by mere words or sentiment, but by a substantial injection of capital. This represents a situation of high effort, yielding only a small result. Despite the immense volume of selling pressure, the price was unable to push any lower. This signifies absorption at the market's lowest point, suggesting a potential area for price reversal. Our second critical pattern to understand is called buying climax. Let's now envision the market in a contrasting yet equally significant situation. Following our last discussion, imagine a market that has been steadily climbing for weeks, fueled by positive news and widespread optimism. This sustained rally encourages retail traders, driven by the fear of missing out, to eagerly enter the market. Then, you witness a massive green candle appear on the chart, accompanied by an extreme surge in trading volume, the highest recorded. Most market participants would interpret this as a clear sign of overwhelming buying power and strong bullish momentum. However, here's the crucial twist: this isn't genuine buying strength. It's actually significant selling activity cleverly disguised. Large, informed investors, often referred to as smart money, strategically utilize this immense wave of buy orders from smaller traders. They leverage this peak demand to quietly unload their substantial positions, distributing shares without crashing the price. Essentially, they are selling into the market's eagerness, maintaining price stability while divesting their holdings. Consider a vendor at a bustling night market. Their busiest moments are precisely when they can sell the most. That period of highest activity is when they efficiently clear out their remaining stock, capitalizing on the high demand. The very moment you're swept up by FOMO and decide to buy at the market's peak, smart money might be discreetly exiting their positions. Moving to our third significant pattern, let's explore what's known as the no supply test after an established uptrend. After a period of rising prices, you observe the price pulling back slightly, which might naturally make you wonder if it's a correction. Upon closer inspection, you see a small red candle with exceptionally low volume, as if the market is silently inquiring, is there anyone genuinely willing to sell here? The low volume decisively answers, no, there's no real desire to sell here. This confirms the no supply condition, indicating sellers are absent. With sellers seemingly gone, the uptrend is poised to resume. It's like cautiously approaching a fire. If it feels cool, it's safe to proceed. These three distinct patterns are unified by a single, powerful mental model: the relationship between effort and result. Grasping this principle alone allows you to decipher about 80% of what volume reveals on any given chart. But before we delve deeper, it's crucial to address the most prevalent misunderstanding in interpreting volume data. If you've been making this particular error, don't be concerned. It's an extremely common pitfall that almost everyone encounters. The widespread misconception is that a green volume bar signifies buying pressure, while a red one indicates selling. This, however, is fundamentally incorrect. The undeniable truth is that every single transaction in the market, without exception, necessitates both a buyer and a seller. For instance, if you acquired 100 shares, it means someone else simultaneously divested those exact 100 shares to you. Volume fundamentally measures the sheer number of transactions occurring, not which specific side, buyers or sellers, is prevailing. As for the color you see in a volume bar, it is simply a direct reflection of the corresponding price candle's color. Specifically, if the price candle concluded its period higher than where it opened, the associated volume bar will be colored green. Conversely, if the candle closed lower than its opening price, the volume bar will appear red. It's as straightforward as that. This coloring convention has absolutely no bearing on which group, buyers or sellers, is currently exerting more influence. It's a frequent error, but many mistakenly believe that a green volume bar signifies buying and a red one indicates selling. However, this common assumption is entirely incorrect. The actual market mechanics operate quite differently. Every single trade executed invariably requires the participation of both a buyer and a seller, without any exceptions. For instance, if you acquire 100 shares, it means another party simultaneously sold those very 100 shares to you. Consequently, volume merely tallies the sheer quantity of transactions rather than indicating which market side is prevailing. As established previously, the color of a volume bar simply reflects the corresponding price candle's color. This coloring holds absolutely no significance regarding whether buyers or sellers are currently exerting more influence. Imagine the bustling scene at a fish market at 5 in the morning, teeming with activity and high volume. Despite the market being busy, you cannot claim it's solely buying because both buyers and sellers are actively participating. To discern which side is truly dominating, your focus should be on where the price candle ultimately closes. Therefore, the crucial rule is to disregard the volume bar's color and instead concentrate on its actual size. The real narrative unfolds when you combine the volume bar's magnitude with the candle's closing position. Let's now turn our attention to one of the most potent early warning signals in comprehensive volume analysis: volume divergence. While price and volume moving in agreement suggests a healthy trend, their disagreement creates a vital early warning system. A robust trend typically shows price and volume moving in the same direction, indicating underlying strength in the market. For instance, a sustained price increase should be accompanied by rising volume, while a healthy decline sees volume decreasing as selling pressure wanes. However, a crucial early warning system activates when this natural agreement between price and volume breaks down, signaling divergence. Consider a situation where the market's price continues to ascend, forming new highs, giving the impression of an incredibly strong rally. But if you then examine the volume bars, you'll notice they are consistently shrinking, meaning each subsequent price peak occurs with less trading activity. Think of a rocket launching. It begins with its engines firing at maximum power, propelling it upwards with immense force. Yet, as its fuel supply diminishes during the flight, the thrust inevitably weakens, causing the rocket to slow down and eventually lose its momentum. This dwindling volume during an uptrend reflects the market's momentum fading, indicating that fewer and fewer traders are willing to support the move higher. The inverse scenario also applies. If prices are dropping, but the trading volume is also steadily declining, this suggests sellers are becoming exhausted. Each price dip occurs with less and less participation, signaling that the selling interest is drying up, often preceding the formation of a market bottom. Volume divergence serves as your invaluable free early warning system, indicating the market is tiring even before a significant price reversal occurs. It's much like the applause after a series of speeches gradually quieting down. The audience is losing interest, and the show is nearing its conclusion. Therefore, when you observe price making higher highs while volume simultaneously creates lower highs, it's a critical signal that a significant change is imminent. Now, let's transform all these insights into a straightforward, three-step process that you can immediately implement on any chart in any market, starting today. This powerful methodology is what I refer to as the three-step volume check. The initial phase, step 1, instructs us to simply zoom out on the chart. Before scrutinizing individual price bars, expand your view to the daily or even weekly time frame. Here, you should first assess the overall trend of volume. Is it generally rising or falling? Also, investigate whether there have been any recent uncharacteristic surges in trading activity. Consider this akin to checking the broader weather forecast before focusing on specific rain showers. Understand the climate first. Proceeding to step 2, we now zoom in on the crucial price levels. Pinpoint all significant zones of support and resistance clearly marked on your chart. Then, carefully observe how price behaves as it approaches these boundaries, applying the effort versus result principle. Should price hit resistance with a volume spike, yet the candle remains small, that signifies absorption. The barrier is holding strong, so exercise caution. Conversely, a genuine breakout occurs when price smashes through resistance with a large candle and substantial volume, showing effort aligning with result. However, if resistance is breached on unusually low volume, remain highly skeptical. A breakout lacking conviction frequently turns into a deceptive trap. Finally, step 3 emphasizes the absolute necessity to patiently wait for confirmation. Many traders err by acting on a single signal, resist this urge, and, after any breakout, always allow for further validation. The crucial aspect of step 3 is to patiently wait beyond the initial breakout candle. This allows for further market validation. Specifically, observe if the price retreats to retest the previously broken level, turning resistance into support. Should this pullback occur on diminished volume, it strongly signals a no supply test, indicating seller exhaustion. This means the market has thoroughly checked the level and found virtually no opposing selling pressure remaining. Such a scenario provides the robust confirmation you need, validating the strength of the breakout before entering a position. Exercising this patience for just one additional candle can ultimately prevent you from making 10 costly losing trades. Let's now consider a practical illustration. Imagine price steadily approaching a well-defined resistance zone on your chart. Initially, by zooming out, you observe a consistent and steady volume leading up to this critical resistance point. As price touches the resistance, volume suddenly spikes, yet the candle itself remains small with a prominent upper wick. This clear divergence of high effort, yielding a small result, unmistakably indicates strong absorption occurring at that level. Recognizing the wall is holding firm, you wisely refrain from buying, choosing instead to patiently observe further action. Subsequently, the price declines, confirming your cautious approach and successfully helping you avoid a potential trap. These three essential steps, zooming out, focusing on key levels, and awaiting confirmation, constitute your powerful volume playbook. Before your next trade, quickly run through a checklist. Is volume increasing/decreasing? Does effort match result? Are there unusual spikes near key levels? Is volume diverging from price? The fifth crucial point asks what the subsequent candle confirms, emphasizing that you should never base decisions on a single bar. By thoughtfully addressing these 5 questions, you transcend mere speculation in your trading approach. Instead, you are actively interpreting the market's language, discerning tangible evidence behind each price movement. This shift occurs because volume transcends being just another graphical representation on your trading screen. It truly acts as the ultimate revealer of truth within the complex market environment. While price can be easily swayed or even intentionally influenced by various factors, volume tells a different story. Volume distinctly highlights precisely where significant capital and genuine conviction are actively entering the market. If this presentation has finally illuminated the true forces driving market candles for you, please share your thoughts below. Tell me, which of these powerful volume patterns will you prioritize in your upcoming analysis? Will it be the powerful stopping volume, a clear buying climax, or perhaps a critical volume divergence? Make sure to leave a comment with your answer. I'm genuinely interested in your insights. I personally review each and every comment you submit, valuing your engagement. I look forward to connecting with you again in our next discussion on mastering market insights. Until then, remember to maintain your discipline and commitment to continuous learning.